Hi everybody, I hope you are having a good day. Welcome to today's video. Today I will explain to you what am I doing right now in my portfolio and how am I preparing for a potential crash or pull down on the stock markets. And I will also tell you why actually I feel like we are really ready for a pullback on the stock prices, and I'll tell you what I really dislike now and which two things am I actually doing in order to prepare myself for that event. But just a quick overview of my portfolio. As you can see on this chart, I'm again at around 8% return this year compared to S&P 500, which is at approximately 4% return. My cash position has increased substantially compared to my last video, and I'm right now sitting at more than $10,000, which is around 18% of my portfolio. And what did I do to increase my cash position? Well, I have actually sold my 20 stocks of Alibaba when price was $268. I really like the company and I bought stocks when they were at $215 and $230. At those prices I really liked the stock, even though they have a lot of issues, mainly political issues. I like them at that price, but now when they are at almost $270, when I see all of a political risk and a lot of uncertainty around this company, I'm not so eager to stay invested in Alibaba at $270. I also sold 100 stocks of Dropbox when they were trading about $25. I had 600 stocks of Dropbox and they were by far my biggest position when they were at 20 or $22. But now when they are at 25, Dropbox was almost 40% of my portfolio. And simply I couldn't bear that risk of having 40% of my portfolio invested in one single stock. So I have sold 100 stocks of Dropbox and I have bought 10 stocks of Lockheed Martin. And at the end, my cash position has increased by $4,500. I will get back to these transactions a little bit later, but now let's focus on things that I dislike on markets and why I have actually increased my cash position. First of all, I really feel like there is a lot of nervous people on markets right now. For example, you can see here that 2 days ago, all of a sudden, stock markets dropped by more than 1% in basically 2 minutes. And when you see those cracks during normal day without any additional news, you can feel something is not very good. It's like I feel a lot of nervousness under the surface. I don't know, like something is boiling. And I simply dislike seeing these patterns on a market. On top of that, I haven't seen financial news media speaking about this extremely important thing, and that is that yield on 10-year Treasury has been climbing consistently for months. And now we are sitting at 1.2%. You can see that in August we were at approximately 0.5% yield, and now it has more than doubled. And remember, all of other investment classes are priced and are trading at some multiples compared to yields which you can get on bond. So yield on bonds are like your big brother or your father, which you have to listen. That is the metric that you must watch. And again, if yields on bonds are at 0% or at 0.5%, it makes sense to see stocks trading at elevated prices. Now when yields on treasury bonds are rising, multiples at which stocks are trading should come down a little bit. Remember, if we take broader picture on yields on 10-year treasury, you can see this is nothing because of what you should panic. You can see that yields are really, really low if you put them in historical perspective. But if you check short-term movement on the yield of 10-year treasury, you shouldn't ignore it. That's actually what I want to markets to understand. I want to see prices of stocks to reflect this change before deciding what to do with my cash. But now, as you can see on this chart, markets are completely ignoring growth in yields of a 10-year treasury bond. And on top of that, there are a lot of bad news from macroeconomy and all I see on financial news media is new stimulus. I mean, yeah, stimulus are great for stocks. Don't get me wrong. That is why most of my portfolio, like more than 80% of my portfolio, is still invested in stocks. I'm not extremely bearish or I'm not panicking and telling you to sell everything. But I am positioning my portfolio to be more defensively positioned. Again, by doing two things. Thing number one is that I am increasing my cash position. I went from 10% cash in my portfolio to 18% cash in my portfolio. And not only that, but I have sold some tech stocks which are trading at higher valuation, like Alibaba and Dropbox. And I have bought Lockheed Martin, which is trading right now at PE of 12. Great balance sheet and great dividend yield. That's value stock. And those perform much better in times when stock market is declining. But in case stocks keeps going up, I will generate solid return on Lockheed Martin. But in case stocks go down, I think Lockheed Martin will also perform well. and I will perhaps be able to sell it for a decent price and maybe buy stocks which have dropped substantially more than value stocks. That is actually my plan for potential crash on stock market or at least substantial pull down. For example, you can also see it here. No matter we have bad macro data and growth in yield on 10-year Treasury bond, fear and greed index is at 70. That's not extremely high. I've seen it at 95 several times, but sentiment of investors is extremely good, and or as you can see here, greedy. And that is when I want to sell my stocks. When everything is pretty, when everything is nice, when everybody is generating high returns. Because if sentiment is greedy, of course it can get more greedy, but there is only one opposite thing from greedy, and that is fearful. That's when I am going to deploy my money on stock markets. And if you want to outperform S&P 500, of course you can invest in high growth companies which will outperform S&P 500. But if you don't want to risk a lot, but you want to outperform S&P 500 on a long run, what you have to do is to ride several waves like I'm doing. When stocks are extremely high, you rearrange your portfolio by going from high growth stocks, at least partially, from high growth stocks to value stocks, and from high growth stocks to cash. Again, bear in mind that around 80% of my portfolio is still invested in stocks. So you don't have to go 100% cash because nobody knows where stock market is going in the future and if we will have crash. Because there are people which are saying that stocks are expensive since 2014 or 15. So you have to be invested, but be smart. Track metrics, track macroeconomy news, check different indexes and how expensive is S&P 500, but also keep an eye on yields on 10-year Treasury bond. If those keeps going up, stocks will have to retreat, multiples on a stocks will have to compress a little bit. And that means you might have really nice buying opportunities on great companies.